Good afternoon, everybody. Welcome back to Schwab's YouTube coaching channel, Trader Talks. It is time for After the Close. I'm your host, Kevin Horner. Thanks for being here, everyone. As we head forward to a big market day tomorrow, Friday, it is Jobs Day, and we will be hearing about the unemployment rate. We'll be getting non-farm payrolls, plenty to potentially move the market tomorrow. So today, admittedly, might be a little bit of an interesting time to be looking and considering taking new trades. But nonetheless, we're going to forge ahead. We're going to look at today the S&P 500, how we finished. We're going to look at a few stocks that made moves that traders might utilize as potential opportunities from an example standpoint for our process. So we're going to talk around the plan of building a trade to take advantage of some of these maneuvers. We need to look through our example portfolio as well, make some adjustments there. We did have one of our example portfolio trades placed recently come to fruition. It completed itself this morning, in fact, during Trader Talk that I was hosting. If you missed Trader Talk, we're going to cover that one today as well. So plenty to cover. You can say hey to James Boyd there in the chat. He's going to monitor questions and comments that I'm unable to get to, but of course, I want to hear from you. Please feel free to post there for the duration of the show. We're going to go about 40 to 45 minutes in total. And don't forget, tomorrow being Friday, it is ETF Friday, so James Boyd and I will be hosting Trader Talk in today's market at Market Open tomorrow. The ETF version of this class is not archived, everyone. So it's a great opportunity for you to see this class, and obviously you can't get it in archive, so the only chance to see it is live. So set your calendar, make sure you're there at Market Open tomorrow with us as we review what the Market Open will look like, and obviously the jobs number that is likely to dictate the market tomorrow. So plenty to keep an eye out. So let's cover our disclosures and then we'll move into the charts, everybody. Please remember that our discussion here is informational and educational only. We are not making recommendations nor endorsements for a specific approach to trading the market here. We will discuss technical analysis. Important to remember that technical analysis is merely a piece of the puzzle. We discourage you from making your decisions off simply technical analysis or exclusively technical analysis. And in truth, you probably need a few bullet points when you're making decisions anyway. So the more data points you incorporate to your decision making, perhaps the better. We will discuss options. Remember that options are not suitable for all investors. They do carry a higher level of risk. You'll need to be familiar with the characteristics and risks of standardized options. You do need to be approved in any individual account in which you might like to place an option trade. One key component as it relates to options, everyone, bear in mind that if you are the seller of an option in a live money situation, you can be assigned at any time, including up to expiration. But when you're the seller of an option in a paper money account like we utilize here in the Thinkorswim desktop application, you will never be early assigned as the seller of an option contract using paper money. However, that risk is real. Even if your transactions are, or your positions, I should say, are out the money, it is not enough to be out the money to suggest that you won't be assigned early on a short option. So please keep that in mind as well. All right, so let's jump to it, everyone. Turns out we had a far better day than maybe we had expected at the close here in the S&P 500. Take a look at that beautiful candle we have at the finish. I'm going to zoom in basically over the last 3 months. We talked this morning about the wonderful bounce off horizontal support here at around 63.50, but the candle today is significant because not only is it a big, beautiful green candle that shows the extension or the continuation of this 3-day pop off support, it did finish at the close. Now, the question, of course, will be, how is the jobs number conveyed tomorrow? Is it one of those details where we get too many jobs added, where the strength of the market is suddenly too great? That's a possibility, of course. And a too hot job market could cause the S&P to pull back pretty aggressively, because a too hot job market or a too strong economy might keep the Fed at bay, believe it or not, even though we have high expectations for a rate cut here in the middle of September, 2 weeks out from yesterday. So that's no guarantee that we're going to get a too hot reaction. We obviously could get a Goldilocks reaction, which would bring us into the expected range of new jobs between approximately 25,000 and 250,000 jobs added, and an unemployment rate between 4.3%, 4 to 4.3%, excuse me. And that would be very stable. That would tell us that everything we've expected would be kind of status quo, and then the expectation might still be for that September rate cut compared to the too hot jobs number that might imply a potential for no cut, which is possibly dangerous to the market here. And then, of course, the third alternative option is that the market gives us a too cold jobs number, fewer than 25,000 jobs added. And that kind of weak data could lead to concerns about recession once more. And the more that that word makes its way into the lexicon, well, the concern can hit the market. And so we wouldn't want, obviously, if I'm being very obvious about my comment, I think we would, of course, want the so-called Goldilocks approach, which would tell us that our expectation of rate cuts and for health of the economy and everything that we've put that's put the S&P back to the 6,500 number is validated. Ultimately, that's what we're hoping for. But we have to be aware that that may not play out that way. So tomorrow morning at 8:30 a.m. Eastern, an hour ahead of the open, very important time frame to be watching. And of course, if we can get that Goldilocks, well, then we have the opportunity to break our trading range. And then JB and I will be talking about the S&P trading through 6,500 to the upside and looking for more upside opportunity. The range we would be breaking if we took out 6,500, everyone, would be about 150 S&P points. And that could mean a potential target there around 6650 in the SPX. Not to suggest we're going there. Everything hinges on the morning's job number. So keep that in mind. And then as we take a peek at the NDX, we're going to see something a bit similar, right? So everything moving off of that horizontal support line that we tested earlier in the week with our week open on Tuesday. And that horizontal level has been held. You got a hold move yesterday with a close above the high of that day. And then today, continuation back above the 20-day. There once more, we will see whether this is valid. Regardless of today's price action, I'm afraid the most important detail we have on the table is how is that jobs number, does it come through? And maybe more importantly, not how does it come through, but rather how do we market participants choose to react to that jobs number? Okay, so we got plenty to keep an eye on tomorrow morning. I can assure you, JB and I will be primed and ready to rock and roll for all of you. So please put that on your calendar and join us for Trader Talk tomorrow morning. Now, today, I'm going to give you a few interesting examples of ways traders might choose to position themselves. And we're going to, for purposes of our discussion, for essentially the most part, we're going to ignore the so-called risk of tomorrow's jobs report, simply because I want to go through process and planning of some example trades. And I don't want to hinge those decisions really on how the jobs number comes out. I want to talk about what the chart tells us and how traders might take that regardless of a job number that could make tomorrow a little messy. So we're going to go forward as though there were no jobs number. We're going to talk about one stock that has seemingly pulled away from a bit of price action. That's Oscar Health. And I say pulled away because it's made an interesting move in the most recent few weeks here. I'm going to go ahead and lift my volume profile from the chart. So this will be a little bit easier to see. And take a look at what I've drawn in here. So this is the year basis, right? 1 year daily chart. If I go back to a weekly, I've got a trend line in here that I thought was maybe a little more appropriate, but it seems not. So I'm going to redraw this and just capture these recent lows so that we can kind of see the long range trend. But what caught my eye on the daily chart, of course, is the movement through this ledge right here. Because getting into this level at around $18 had proven recently to be difficult for the stock to get through, as you can see. So here we are, make that a red line for us. Let's just call it 18 as it turns out. Let's just make this real simple. I like to use round figures as close as I can. And so we'll make this now a green line because we've moved through it. at 18. So the hope now is that you have an opportunity to gap and go, which is essentially what you have today, right? The stock closed yesterday at 1768, opened today at, where's that open? 1835. So a real nice 60 cent, 65 cent gap move, and it held the level all day. Now it is giving one of those indecision dojis, right? So perhaps there's an opportunity for this to be a fake out breakout, but at the same time, having moved through a very significant level, I think the notification I'm going to maybe lean into here is the fact that we closed above this level for the first time since June 18. And when we did that last time, we got very enthusiastic for a quick minute there, didn't we? Right up to 23 bucks a share almost. The high that day, 22.78. That's what we're looking to capture, is that type of a momentum-based move. So could traders look at this and position themselves for a longer-term breakout opportunity? I'd say they absolutely could. And so options available to them certainly could go out a period of time, not to necessarily incorporate the most likely earnings window in early November. So maybe something out to the end of October, because of essentially we're calling it the breakthrough of a certain level, right? Now, Wiley, I understand where you're coming from. The chart has been back and forth. It's been fairly choppy in here, right? One other consideration is that you are witnessing an improvement to this space kind of broadly as well. So if we went over here and captured, let's take the healthcare space, could we validate an improving healthcare space and suggest that we've got an improving sector that might lead to improvement in individual equities within that sector? We could certainly say that here. Now, it's not out of a downtrend, of course. This is the healthcare sector index for the last year. And you can see we still have a pretty healthy downtrend. So I understand where you're coming from, Wiley, no doubt. What we're going to focus on is simply setting up a trade with the belief that the level we've achieved is the most important factor for Oscar Health at this point. And let's consider a spread that would give us maybe 3 to 5 weeks, somewhere in there, and take advantage of what we think is more upside. Given the nature of the most recent pullback, $22 could very well, again, act as resistance, right? Some of you traders might want something even higher. You might be willing to cap your upside in the neighborhood of, say, 23 or 24, 25. But let's look at the availability of options here for the long call side of things. And again, let's go out a few weeks. So we don't want to get to the November window, but we could get to the monthlies in October. That's going to be about 5 weeks or so. So let's shrink this up a little bit. We don't need 50 contracts. Let's give 30 in here. There we go. All right, so here we are at around 1838. And in the past, we've had this discussion about setting up long call vertical opportunities and doing so with high delta long calls so that you get a greater move associated with the underlying stock in the price of the option. So remember that if the position here, Oscar, goes up by $1 and we're incorporating a delta of, say, 67 cents here at the $17 strike, well, then we might expect this contract trading currently 265 by 275 to increase by about 65 to 70 cents, essentially, right? That's what we're looking for. Now, additionally, another definition here of delta is that it is the likelihood that that contract on expiration Friday, in this case, October 17, would be in the money at expiration. And so some traders lean into that, saying, well, if this has a 2/3 or a 67% likelihood of being in the money, then maybe I've got a chance of finding some value from this contract, even if I don't make a massive or a big move to the upside like I'm hoping for or planning for, right? So some traders will lean into that larger delta. And in our case, going out this far, a contract cost us $275. And if we are willing to cap our upside to that 22, 23 level, well, then we have a chance to reduce the cost of our contract. So 65 cents here is the midpoint of the $23 contract. So in between it, we'd probably be looking at about a $2.05 total cost on that spread. And, moving from 17 to 23, that's a $6 spread. So that means that we would actually be risking about $2 for the potential to make 400 from the deal. Remember, quick math, a little back of the napkin math, as some of us suggest, the difference in width of your spread, less your cost, gives you your maximum gain when you are the buyer of a spread contract or a spread like this. So let's set that up, everyone. Let's go with this idea of incorporating the in-the-money contract at the $17 strike. So we are going to pay a little bit more. And then I'm going to hold down the control button over on my keyboard. I'm going to click on this here, the bid, and that's going to set me up for this trade. And there it is, my debit of 205. Let's go ahead, because we have a ballpark to about $500 max loss. Let's go ahead and make that 2 contracts at 205 for a total. Well, let's see if we can get in at 205. That would be great. Let's make it a padded limit though, because I'm reminded market is closed. So if we want to be put into this position and do so at market open, we have the risk that the stock opens higher. So we need perhaps to go with a padded limit, as I call it, simply put, that just says we're willing to pay up to this, but if it's lower than that, give me the lower price. That's the or better limit order, right? The standard limit. So let's go up to 220 for 2 contracts for a total cost of 440 approximately. And again, our max gain will be $6 less 220, so 380 approximately. And this is how it'll break out. 760 on, I said 380 per contract, 760 for the 2 of them. So there you go, everyone. Buying 2 spreads, essentially. 1723 is the strike, and a limit of 220 in the hopes that it opens at our relative close valuation here on Oscar. So there, quickly for you, is a long call vertical on Oscar. And one of the things I heard from you all was a desire to see more of these strategies, more conversation around individual examples. And so we're going to keep it rolling with an example on Match.com. Now, Match popped up on my 20-day moving average watch list, which again is a scan. I have shared that a number of times in this class. I can certainly do so again. You'll find it in the show notes most consistently, everyone. But ultimately, that's where Match came from, and there's at least it did. Yeah, there it is. It's right on the list right here. And then there's another one I'm going to show you here in a moment. But I wanted to go with Match as an example because I felt as though it's set up based on this nice uptrend working off of a essentially matching lows down here, and started rallying, working through the 20-day moving average. Basically been holding the 20-day all the way back to July 1. So you've had 2 solid months. Yesterday it was made a nice move back up against it, and Tuesday opened weak here. But I think in this instance, we're going to go with an equity purchase. So just shares of the stock, but we are going to force it to make its move first. So we're going to place here a buy stop order. Now, before I zoom in, let's zoom out and just take a peek at the resistance levels we have seen in here, everybody. Notice here that the last time we got into 39 was pretty notable. It led to a pause in the rally. Now, it didn't mean it reversed. It just led to a pause. We pulled back a little bit, right? So 39 is a very big number for us, and maybe this is one of those deals where you set up multiple layers. Last week we did a layered approach to buying in on a stop order and then buying as we made a new high as well. That's one way to look at it. So while I've set this level right here at basically 39, the alternative is to be a little bit aggressive. And how would that look? Well, the trader who wants to be aggressive maybe gets started on a buy stop that takes you through this layer right here at about 38, because each of the last 2 weeks, each of the sessions in the last 2 weeks, I mean to say, And we've been testing or pulling back from that $37, $85, $38. If it trades through 38, there's a really solid opportunity. I should say that's wrong. Let's back that up. If we trade through 38, well, now the opportunity is greater for it to visit 39, right? Just by virtue of the fact that we've moved through a level that we haven't seen in 2 weeks. So the percentage of likelihood increases that we can get to 39 if we can just get through 38. And so rather than being a buyer immediately, this is where the trader might say, let's do that buy stop order. And the option for the example is going to be buy stop at maybe 38 and a quarter with a stop us underneath us here, somewhere under this ledge right now, like so under 36 and a half. And then that means we'd have to set a target quite nicely above 39, right? So there is a little bit of risk here, of course, because we do have a couple of ceilings. The risk is we buy on the break of 38, and then we run ourselves into 39, and then we reverse course. Certainly a risk, but our goal is to limit our risk by exiting under 36 and a half. So we will do a one cancels other buy stop with a stop exit order. That'll give us the chance to stay in the trade as long as it doesn't take out or make a new short-term low. All right, so we'll probably set that somewhere around 36. So that would give us about $2 of risk, depending on where we buy with our buy stop order. So I'm going to set that up with a right click, buy custom with stop. So we're not putting the limit order out, just the stop for our protection purposes. Now there's going to need to be some reminders for you all as it relates to the order entry. Both of these will set as we'll make them both good till canceled. Both are stops. Now remember, the buy stop, that means that if we trade through $38.10, even intraday tomorrow, I'm setting 10 cents above 38. I'm just trying to give us a little of encouragement, meaning we moved through 38. We did so maybe a little bit further than we have in the last 2 weeks. That might be a good reason to be a buyer. But if we opened over 38.10, let's say that's hot. Let's say that the number comes in Goldilocks. We open at 39 tomorrow. Our buy stop is going to be entrance at 39. Okay, so we got to be careful about that. We have to know that we're not guaranteeing any price with our buy stop. And then our exit strategy, the same thing we're going to suggest. We can't guarantee price in any way, but our goal is to mitigate our downside risk by incorporating the sell stop order if it trades under and makes a new low. I'm going to say 35.97. Nice and non-round figure there, making them both good till canceled. All right. Well, Nirmal, I'll tell you what, that's not an invalid view, although it's very interesting right now. Everything I continue to see is that the birth rates continue to decline. So, maybe we don't necessarily need fewer people. Maybe it's happening automatically or organically, we might say. So, nonetheless, match a buy stop order if we trade through 38.10 with a sell stop order if we get put into the position and then trade under 35.97 or at 35.97 or below, we'll move on from this trade. There is a buy stop with a sell stop as a risk mitigation factor. Remember, no guarantee of price for either of those trades. All right, so there's match, both set up, ready to go. The other one I was looking at, we've got two. I'm just going to give you the rundown. I'm not going to place these trades, but I thought that these both looked rather interesting. One of them is Masco. So Masco has recently moved out of a downtrend. Depending on how you define it, some traders would say that the movement above the 200-day moving average is sufficient to eliminate that. Other traders would say, well, the fact that it's taken out the downtrend line would be the key. And still further, more traders might say it's the fact that it pulled back and tested what was a resistance downtrend line, and now today is giving a hold move, closing above the high trade of its low day in the pullback here today and getting back above the 20-day. That might be the beginning of something larger under development, right? So for those of you wondering, if we scooted over to the Analyze tab, they fall under industrials, but essentially they are in the plumbing product segment, in faucets and shower heads, handheld showers and valves, bathware, etc., etc. Interesting because it's as a group, not alone in its movement. One of the oddities we've seen of late has been an improving move from the home builder space. And I can just kind of point this out briefly here. I know I've got home on here somewhere. Let's see, home construction total index. There you go. So an improvement on a broader level. It, again, is a wonderful reminder of what is happening in a market. The market is not the economy, right? Because if you were in the economy thinking that that's what prices are doing, well, you basically have been told for the last 3+ months here that this industry has turned a corner, even though maybe in our world, in your area where you live, you might not see it having turned a corner, right? You might still see housing being a very tight supply versus a tight number of buyers or interested buyers or even of opportunistic buyers. I mean, it's kind of hard right now. So things are changing in quite a number of key manners. So hopefully this is something that JV and I can talk about for you all tomorrow. So going back to Masco, like I said, I'm not going to build a trade here, but I wanted to bring that one up as a potential example. And if we were playing with example bullish concepts, this might be one where a trader maybe simply buys some shares. Maybe the trader looks for a potential example long call vertical scenario. Maybe the trader decides they'd like to own shares, and maybe that trader wants to stay bullish, but would prefer to be the seller of options. Maybe they're looking at selling something in the vicinity of the 50-day moving average on any short-term weakness, that could give them the opportunity to be a buyer lower in price. Heck, that lower by maybe $5 could make some sense. So that's a little interesting. But remember, as a trader, you can be bullish in a number of key ways. Yes, you can buy the stock. Yes, you can buy the call. Yes, you can sell a put. You can buy the call and sell a call higher. You can sell a put and buy a put lower, so you've got the protection built in. A lot of ways for conceiving of being bullish. It's important that we as traders define those for ourselves so we know which ones are the ones we want to work with. Hopefully that helps you all make those decisions. Another one that was pretty intriguing to me this afternoon was Walmart. And the main reason is that Walmart is in a space that if technology is going to underperform in the near run, something that has been discussed as we've witnessed a little bit of a rotation out of tech and more into, and this is good for the broader market, of course. We often discuss the idea that we don't want that money to leave the market. We don't mind if it sells out of one group and moves into another. That's okay. That's the kind of market we like. That's a healthy development, broadly speaking. So Walmart finds itself under the Staples Group, which is one of those so-called defensive groups that can do well during periods of slow growth or technology lagging. And what I found notable here was a well-defined area of short-term support. So something like, I'm going to go with a rectangle instead of just a line. So something like this, which happens to catch all these recent lows in here, recent high back here. So resistance could become again supportive. If I put the volume profile back up, it's going to also validate this level that we've moved through. This is the volume point of control for the last year. This is the point where we've seen the greatest amount of volume. So that's essentially an equilibrium price, and we've moved through it. And some traders would also draw a line off the peak and say, Kev, we are either breaking it or have broken this pullback. And so maybe they're going to get a little bit enthused by that. So that bears watching, as does the prior high up here as well. So prior high in the ballpark of 105, 105 and a quarter. That could be the extent of any rally. But if you take that lid off, blue sky remains above. That's not a negative either necessarily. So bear in mind all of the aforementioned detail when maybe considering Walmart as a potential example here. We're not, like I said, we're not going to trade it, but I wanted to make sure I brought it to you because I'd heard from so many of you saying, hey, I really like the trade ideas. I don't mind going through the example portfolio, but I want as many trade ideas and trade examples as we can. But this way I can give you more examples without devoting too much time to the planning process, which will allow us to manage our example portfolio. Speaking of, let's take a look at that example portfolio. Off the jump today, I mentioned we got taken out of our Apple trade. So let's look at how that trade went for us. I'm going to go ahead and drop Apple into my account statement page. We bought last month, about 4 weeks back on the 8th of August. And so a little quick look at my calendar reminds me the 8th of August was in fact a Friday morning. So we did buy, I remember now. I was actually I believe I was in New York City this weekend during this purchase and made this as an example trade. And we had put this on it as a trade that was breaking out essentially, and it was on the day of this big candle. So we set this level in the hopes of getting up to about 240. And that's exactly what happened. In fact, it got taken out or it executed today. Let's go ahead and put the trades on. There's a few of them in here, but essentially we bought here on the big candle day and we got taken out of it today. So we bought in at 223, sold at 239, walked away with about 16 plus on the position, 100 shares. That trade worked out. They're obviously not all going to work out like that, but it's a lovely when they do. I will mention that we did incorporate a bracket on this order, everyone. And the reason I'd like to mention that is that when you peek at what happened here, yes, we bought on the biggest move day, but we also were able, because of my comfortable stop at the time, able to maintain these lows and not get stopped out, allowing the 20-day moving average to continue to the upside, gave us a successful test right there. And because I incorporated a stop with enough wiggle, I didn't get taken out of it, and we were able to make our max gain on the trade. Like I said, it's not going to work every time, but it's important when we're evaluating our ledges of support. It's one of the main reasons traders will incorporate that average true range when thinking about a stop order. Pick a level of support, go beneath that level by the amount of the true range, whatever that might be. Those of you not familiar, I have average true range, or ATR, added as one of my study details above, so I can click on it. So, if you were the trader that was still in it and wanted to work with the 20-day moving average, then today you might look at this and say, all right, $4.57 beneath the 20-day. Some traders would just say, let's round that up. So let's just make it $5 beneath the 20-day, which is 230.18 right now. All right, so 225 gives you an approximation for where a trader might consider putting in the stop now. And 225 would mean you'd have to violate the white line here, right? So you know what? If you violated the white line, there's a greater likelihood of a test of the 200-day in blue, a greater likelihood of the test of the 50-day. You might not want to be sticking around for it anyway. So a great reason maybe to consider utilizing a stop order. Again, when you use that basic stop, no guarantee of price, but mitigation of risk is our goal as much as possible. Yes, we want to profit, but we don't want to lose money either, or we want to limit the amount of money we are capable or willing to lose. All right, let's go ahead and eliminate those orders, those trades rather. And then we also have some example from the monitor page that we need to check out here. Let's see. We had a trade that didn't go so well initially here in CrowdStrike. So let's take a look at CrowdStrike. First of all, we have a 430, 460 call spread, long call spread. So we have a bullish trade on. And I want to draw your attention to the fact that our short call, the 460, has lost some value, right? $1,225 is our profit, and only $500 remains in that short 460 call. So make note of that, please. Just put that in your head and remember that we are profitable on our short call. We are currently losing money on our long call at the 430 strike. Together, we're down $667 currently on the spread. Okay. Now let's look at CrowdStrike, which we bought with the belief that we had a candle that we could really sink our teeth into last week. And that did not develop positively. So let's zoom in a little bit. Now, we should make note that contract is for October, so we're not going to overdo it. Okay, we're just going to stay true to our trade. But this was the day, this big, beautiful candle. Let's be honest, huge candle, big volume, following an earnings report. Everything about this candle gave you plenty of reason to be bullish or optimistic. Well, what's gone on since? We've pulled back to the 200-day moving average. Now you've got a couple of days that are intriguing to traders. You've got basically a set of railroad tracks here over the last 2 days with these long tails. Both of these days, everyone, basically back-to-back dojis with a close barely above the open yesterday and a close barely below the open today. So yesterday green, today red. But most important, I think a lot of traders would suggest back above the 200-day at the close. All right. So here we have another potentially a validation of support. So what I want to talk about briefly is the way that a trader might manage this long call vertical that has moved against them now. If the trader were willing to do so, the trader could absolutely cut this trade off and say, I'll walk away, I'll lose my $667. They'd be foregoing time, right? We've still got 5.5, 6 weeks to go. The trader also, however, could decide to simply buy back the short call. So we sold this, right? We sold that short call for about $17.40. And here it is at $5. Yeah, $17.40 was our trade price. It's at $5.15. We could take that $1,200 in profit and withdraw it by buying back this contract tomorrow morning for $5.15, and we would make $1,225 on that. Now, the reason that a trader would want to do that is that essentially bring you back to why you sold the call in the first place. We set up a long call spread so that we could buy the call and have a lower cost to do so, right? So we would have otherwise had to spend $3,200 to buy that call by itself. Well, by selling the 460 against it simultaneously, it allowed us to put on the vertical for only $1,460 outlay, okay? Now, the trader who chooses to cover this now says, I believe there's more upside. That same trader also has to believe that they're comfortable risking all of that $800, all that is in value of the contract that remains for the long call, the $1,300. Okay. If you are, as a trader, more concerned about losing the remaining value, then you would want to stay the course and either A, exit the vertical entirely, or B, do nothing. But if the trader said, on second thought, yes, I can see that there's more risk here because I could cover the short call, own the long call. My risk would be that I could lose all $1,300 value of the 430 call, but you would also eliminate your upside cap, right? Right now, you have upside limitation to 460. If you pull that off the table, though, there will be no limitation to your upside on the 430 call. So if you believe that there is more upside in CrowdStrike, some traders might choose to take that short call off and let the long call run and see how it goes. Okay, but admittedly, you will be taking on more risk, right? Because we have $800 in market value in the combined trade right now. That's what's at risk right now. If you do nothing, right? If you take off the short call, we are then risking the remaining value, about 1305 in that call, the 430 call. So you got to be comfy to do that. We're not going to take any action. We're going to let it go, but I wanted to discuss it. I wanted to give us the opportunity to see the potential merit in covering that short 460 call, simply because we've basically gotten, I mean, a heck of a lot of that percentage out, right? Like 75, 65% of the original amount we sold has already been reaped. So we could choose to cover that. All right. So there's a look at the CrowdStrike. And then the other one that we placed last week was the Globe Life and the GL. This was a buy stop, I believe. I think that's what we did. Let's change our symbol here and take a quick peek. Okay, we bought 100 at market. Okay, so we did have, this was, a buy stop order at 141 on GL. So let's take a quick look at that. So here we got long on a close basically it was last Friday. We opened over 121, so that would have been August 29. Yeah, there it is. Yeah, so basically, once it moved through our stop level, we placed the buy, and now we have a bracket on. Because we have a bracket, we really have no reason to make any adjustments here at this point, everyone. So once more, we will stay the course here, but ultimately, you will stay the course because we obviously have this trade working in our favor, or at least I should say working in the sense that we're in the trade, we've got our limit, we've got our stop, and we spent the time last week to build that trade. We'll let that one go. The only other thing I wanted to look at today was HOLX, which we tried last week. And, this one, we were waiting on a move, giving us a hold, and it wasn't clear. So last week here, we were sitting right here on the 28th. Friday was the 29th, and our order on GL here, say GL, excuse me, HOLX, was, let's see. Yeah, so basically we got expired. We had a buy stop at 67.50 and then another one at 69.70. So as a reminder, what we did here was a layered purchase with the hope being that we were going to get ourselves through the certain price, right? We were going to buy 50 if we could trade through 67.70, and then another 50 if we traded through 69.70. Neither of those scenarios occurred, so we had an order canceled, no execution. This could be an interesting one now for a trade example. Unfortunately, we're a bit out of time, but I'll point that out here. Horizontal support right here, basically. Very lengthy tail with today's lows, so maybe a shift in sentiment, but nonetheless, we've made lower highs, lower lows over the last 7-8 sessions, so maybe one for a watch list more than anything else. All right, lots of discussion today, everybody, but I hope it was worth your time nonetheless. I'm glad you joined us. Remember to join us tomorrow morning. I'll be back with James Boyd at Market Open for Trader Talk in Today's Market for ETF Friday. Remember to follow JB and me on X, James Boyd CS, Kevin Horner CS. If you like the discussion today, go ahead and hit that thumbs up for me. That would be a big help to me. We're going to get this one reviewed and into the archive as quickly as possible, of course. So if you're looking for it, check the archive there tomorrow morning. It should be right at the top of the list. I do what I can, JB. I'm not necessarily humble, but I do try to give you some ideas about things working out. I will absolutely admit when I'm wrong on these trades, everybody. I hope you all know that. I'm more than happy to let you know that the trade we placed didn't work out, but it's even more fun when the trade example works in our favor. Those are great, of course. So anyway, thanks again. Hope you all have a fantastic rest of your Thursday. Let's follow up again tomorrow morning for Trader Talk, everybody. Have a great night.